Welcome, welcome. Thank you for joining us. Today we've got Ben Holmes with F&G. Going to go over some IUL products, kind of just go over when, where, and why to use them. But before we get started with F&G, I wanted to remind everyone that we have 4 days left, including today, to sign up for the pre-licensing at the discounted price of $34.95. After the 31st, it's going back up to $59.95. So I really want everyone to capitalize on, getting licensed with exam effects. So $34.95 until the 31st. So Ben, I'm going to hand it off to you and let's get started.
Awesome, appreciate it. Thanks for the introduction, Rachel. My name is Ben Holmes, and I'm the National Accounts Manager with Fidelity and Guarantee Life. I've been with Fidelity and Guarantee for about 2 months now, but have worked in the industry for about the past 10 years. And I'm going to talk to you guys today about our IUL product, when to sell IUL, why to sell IUL, and really try and pique your guys' interest in what we can do together moving forward. So I'm just going to start talking off kind of about the retirement descent. So with the retirement descent, there's actually more people that actually die coming down Mount Everest than there are climbing it. Gravity plays a part in that, but it also kind of talks about retirement, right? You guys work all the way up till retirement, let's say age 65, but then it's a big deal as to what to do with your money. It's a big deal as to how to not outlast your money, and so you want to make sure that you're covered, right? And that has to deal with Social Security, pensions, what you've saved for retirement, and really what we can do to help supplement that. There's a lot of individuals too that have health issues, and we want to make sure that those guys are protected for that. So I'm going to go ahead and talk about today not only our product, but also why IUL in general. I know you guys have opportunities to sell other IUL. We'll talk about why F&G also. But then we'll also talk about what we have to offer and what we can offer moving forward. So with that, I'll go ahead and kind of get started as to why IUL. So when we look at the industry as a whole, we have everything from term insurance, which is just basically a mortgage protection based kind of product. All right, it only serves one purpose, and that's really to cover any debts that you have outstanding to your spouse or loved ones or businesses, right? There's other opportunities, though, besides just term insurance. We know there's also final expenses, which you look at from a guaranteed universal life. And what that does is that has no cash value. It really doesn't have any access to any of that death benefit, but it's just more of a permanent term. And so where we look forward and what we look to do, there's really 4 things that we really want in a product, and we only offer IUL. So the first one's going to be wealth transfer, right? That's the whole point of life insurance is wealth transfer. It's to protect a loved one or a spouse or a business employee or your other business partner. But we also believe that with the tax codes that we have, there needs to be some accumulation inside of an IUL or inside of a life insurance product itself. Your clients put their hard-earned cash into a life insurance product. We want to make sure that it works for you as well. And then the third one is going to be income. What's the point of accumulation if you can't take it out, right? And so we want to help supplement retirement. We want to help maybe help pay for college, living benefits as well. And that kind of gives me into the fourth one, which is going to be protection. And the protection's based off of obviously death benefit, right? But we don't want to stop there. We want to stop from a downside market. So when you're looking at the protection base, we have a 25 basis point floor. So it's a little higher than 0. So it's contractually guaranteed not to go below that, okay? And so if you have years like 2008 where the market dips 30%, 35%, you're still getting a 25 basis point credit. So you're not losing that. And it's very important for, especially the baby boomers nowadays, to really grasp that and protect their money. But we also look at living benefits. So we do have two riders right now. One is a critical illness, and one is a terminal illness. And I'll go more into that a little later. So I'm just going to go ahead and talk to you guys about what our life portfolio is. Again, we have two products for you guys, so we do make it pretty simple. Real quick, we have the choice product, and the choice product is a protection-based IUL. As you can see, the minimum death benefit for these ages are $150,000 for 0 to 45, and $100,000 issue ages 46 to 75. We offer all risk class, preferred, preferred standard, as well with tobacco. On our choice product, we do have an annual point-to-point of 100% with a cap of 9%, and again, that floor is at 25 basis points. We do offer rolling targets for our choice product, and what that means is, let's say your client's putting in $100 a month, which is $1,200 a year, right? But that target premium is actually going to be $2,000. You have another year in order to recoup the extra $800 that the target was. Okay, so if the target was $2,000, they put $100 a month in, you're actually still getting paid in year 2 for the remainder of the $800. So you have time to make it up, that target premium, so it's not just stopping in the first year. The other product we have is called the Elite, and this is going to be more of your overfunding cash accumulation product. Eligible issue ages, again, are age 0 to 75. We do have a minimum death benefit of $50,000 on this, and then we still have the same risk classes. Now, this one's going to be a little different because we do offer some more indices, and I'll talk more about that here later in the presentation. But we'll just start real quick with the S&P 500. It is a annual point-to-point of 100% participation rate. We do have a floor of 25 basis points again, but then we also have a cap of 14.5%. So that is the highest cap you'll get in the industry. So if you think about it, if they go ahead and they put their money into the S&P 500, they can earn everything from 25 basis points up to 14.5%. That's extremely high. So you know what happens is they're gonna, let's say the market gets 8% on the S&P 500, they'll get the 8%. If the market gets like 16 or 17 or even 18% on a year-to-year basis, they're going to be capped at that 14.5%. But again, this is one of the highest, it is the highest cap rate in the industry right now. We also have what's called a Barclays Trailblazer Sectors 5 Index. And I'm going to go a little more into this today because it is a proprietary index offered only through Fidelity and Guarantee Life. And the real kicker here is that we actually are able to have a no spread. So we're not going to take anything off the top. There's no cap, and it's a 200% participation rate. And I'll kind of go over a little bit more again later in the presentation that explains why we're able to do this. I know a lot of the times when you think, you know, if it's too good to be true, it usually is. But this is actually a real thing for us. This is on every single illustration. So we have a 20-year look back of what the S&P 500 has done, as well as what it's done with the floor and the cap. We have this on the S&P 500 as well as the Barclays. So if you look at the 20-year average right here, you see the 4%. That's taking the highs and that's taking the lows. So if you see the December of 2007 to 2008, it's almost a 40% drop, right? So that does calculate into this 20-year average. However, if you look at the S&P 500 with a 25 basis point floor and a 14.5%, you can see that instead of the negative almost 40% that they're getting, they're actually getting 25 basis points. So it really holds on to the actual principle of that actual money. It's a really big story to talk to your clients about. And so you can see over the last 20 years, it has a return of 7.65%. The Barclays, though, is a little different. This obviously has not been with us or even in the industry for the last 20 years. It's been around for about the last 15. And you can see again, if the Barclays, how this works, you'll see that it actually does have the negatives here on the left-hand side, but if we add the floor, again, the 25 basis point floor with no cap and a 200 basis point or 200% participation rate, we're actually averaging 13.49% since it's been in the industry. So it's a pretty telling story of what's actually happening. So let's go into the power of the Barclays and kind of what it is and what it represents. So a hypothetical situation, we just took a random index in the industry, and we said, okay, if it returns 9%, but there's a 2% charge on that, your average return is 7%. That's still pretty good, right? But with Barclays, with the no cap and the no spread and the 200% participation rate, the hypothetical growth rate goes from 5% to 10%. And we're able to do that with a 200% participation rate. Basic, whatever that product does, that index does, we're going to double that return. So I know this is a pretty simple slide, but it really shows what they can do. So here's some additional resources. I really recommend you guys look at the trailblazer.barclays.com. That has about a 6-minute video on there that shows how this index actually works. And there is a hotline that you can call, and it is people that actually work for that specific index. And it's not a call center. This is actually people that you can talk to that actually truly work for this index. You're probably wondering, how are you guys able to have a no cap and no spread and 200% participation rate on this index? And the answer is pretty simple. You know, they use a theory where they go off of volatility. So the S&P 500, for example, has a volatility of about 20 to 25%. So we pay for options. A carrier pays for options. So when we work with Barclays, since they have a lower volatility, again, theirs is only up to about 5%, we don't pay that much for options. So what we do is we actually go ahead and give that back to the client by offering that 200% participation rate. Think of it as the S&P 500. You know, a couple weeks ago, it was down 800. It was up, it was down, it was up, it was down. It was kind of all over the board, right? Especially in this volatile market we're having. And when you look at the Barclays, they're more of a slow and steady wins the race kind of mentality. You know, they can go and sit in cash if they'd want. And that's what they do, which is why they do have or why we're able to have that 200% participation rate. All right, so we're able to take money, we're able to accumulate that money, but let's talk about how we pull that money out. I'm going to talk about variable loans, and it's a protected and it's participating. Okay, so we're actually going to take the loans that you have, and we're going to put it back into the index, so that way you're able to actually make money off of the money you have borrowed. So let's start real quick. We have a guaranteed maximum variable loan rate of 5%. So we will never charge you more than 5% on that. It is a participating loan. So, you know, if the Barclays gets 2.5%, that's a net wash loan. We can only illustrate a 1% positive credit rating. So that means that we can only illustrate if the loan rate is at 5%. We can only illustrate a 6% return when you're taking loans out. So let's just start about 3 different scenarios, right? So we have a 5% loan charge, but the index that actually credits 8%, that's a 3% positive crediting rate. We have a net wash. So it's a 5% loan charge. It becomes a 5% interest credit. It's a net wash loan, 0% positive. And then last but not least, we do have an example of, let's say we do charge the 5%. The index interest credit is actually 3%, so there is a 2% net charge. I believe the variable loan actually right now currently is only charging 3.89%. So that's a huge thing when you're actually talking about downside protection, when you're talking about taking money out of your account, and you're really trying to help supplement your retirement there. And last but not least, we do have living benefits. And living benefits, we offer as a no charge. It's just a built-in rider to the Index Universal Life. So as you can see, we have up to 100% of the death benefit of those following conditions. So let's say they're, they're putting money away for retirement in our IUL, okay? And then something happens when they're 65 or 70 or even 75%. There are so many stories, and we've heard so many stories where people have had a brain tumor or they had a stroke or someone's had a heart attack. And instead of using a lot of that money that they've stored away for retirement to help with those medical bills, you can actually take money out of your death benefit tax-free in order to help supplement that. That way you're not having to pay that burden of that critical illness. We also have terminal illness, which, if you're diagnosed terminally ill and you have a life expectancy of less than 24 months, we can pay up to 100% of the death benefit on that as well. So if they have cancer and let's say they are expected to live less than 24 months, they can actually access this money. And so they can do something fun with their family, for their family, however they want to enjoy those last few months they have. They can certainly do that as well, and that does come out tax-free. So, we talked kind of about the retirement descent, right? And we talked about our accumulation with the IUL. We've talked about the living benefits. So when I talk about that retirement descent, it's a big story in the marketplace. It's really affecting a lot of baby boomers. It's affecting people that are already retired. We want to make sure that your clients have their money and they have their money when they need it the most. And health doesn't discriminate. You can be as healthy as you can and still have a stroke or still have a heart attack, still get cancer. So there's still a lot of things out there in this world that's going to affect you in your retirement, and we don't want you to fall down the mountain and go bankrupt or have to live off of Medicaid in order to live out the rest of your life. This really helps supplement and balance that. So we do have. I'll kind of move on with underwriting. We do have an accelerated underwriting program, and how it works is we actually take a first look. So if you go ahead and submit an application, it's ages 18 to 50 up to $1 million. So if you submit an application, we'll run some background checks with, we'll pull the prescription history, we'll pull medical history, we'll pull motor vehicle report, and a few other things, and we'll determine based off the application that they send in whether they're pushed through. And that does take about 3 to 5 days in order for that to happen. So if you feel like you have a client that's relatively healthy within our guidelines, so within ages 18 to 50 up to $1 million of death benefit, I would say it'd be probably wise to wait and hold off on getting labs and exams because they might just be pushed through accelerated underwriting anyways. And if they are, we'll go ahead and actually issue that policy. So right now we do have about, it says 27%, we're actually about up to 30 to 33% rate right now. We are looking at improving that, and that's always a process that I know a lot of other carriers are doing and taking a look at and see what we can do. That's definitely something that we're taking a look at to see how we can improve with our accelerated underwriting program. If they do not qualify for this program, they can still obtain a preferred or your standard risk class. We just are going to need a paramedic exam done. So I know I kind of went through quite a bit of that pretty fast, and I'm going to open up for some questions. But before I do, I really want to kind of encourage you guys to look beyond the term sale. Are they maxing out their 401k? Are they contributing to an IRA? Do they have any tax benefits on that end? You're working with clients that say, I only want this, but do they know the actual benefits of having a permanent life insurance policy? Do they know the effects of retirement and outliving their money? Having a critical illness, having terminal illness on their policy. Term insurance, it's great for that mortgage protection sale. But I'd really encourage you guys to look a little deeper, in fact, find a little more see what their overall retirement plan is. You know, make this more of an actual relationship and not so much of a transactional sale. Make sure that they're taken care of and let them know that you'll be with them until retirement, through retirement, and helping them out at each and every step of the way. This doesn't have to just be used for, you know, your normal channel of, you know, a mom and a dad with a newborn in a house to protect. You know, this plan could be used for any businesses, any doctors, lawyers, accountants, CPAs. Work with your P&C firms to kind of get those and work with those business owners and their key employees. You know, talk about college funding, talk about retirement and what they're doing. And, you know, a 401k is fantastic. I absolutely recommend everyone at least put in the amount to get the employer match. But what happens if they're planning on retiring in 2010 and that market hit in 2008? You know, how long do they have to continue to work for in that marketplace? There's so many stories out there, especially with these baby boomers and these local or these recent retirees that are working because of that crash, and they had to work for an extra 7, 8, 9, even 10 years. So, you know, just fact find a little more, see what you guys can do to pull this out, and work more for a permanent life insurance sale. So with that, I'll go ahead and open it up to any questions.
Hey, Ben, Jerrod Ewing, how are you, man?
Hey, I'm doing well. How are you?
I'm doing well. Hey, thank you so much for getting on the call, man. We really appreciate it. And I do have questions for you. How about that?
That sounds great.
Hey, so one of the questions I had actually, did I read that right when you were saying that you said up to $1 million, basically, and we can't call it simplified issue, but it's about as close as you can get, up to $1 million all the way up to age 50. Is that right?
Yep, that's correct.
Is that something you guys have had, or is that something relatively new?
It is relatively new, and we have not marketed as much, but it's something that we've had, I want to say, for at least the last year or so.
Can you shoot me straight and tell me what would take somebody out of the qualification for that?
You know, any major medical condition that they've had, obviously anything with like diabetes or any of that sort. We do pull a TRL credit score, so it's not your actual like FICO score, but it's more based on the lines of your debt to income ratio. And so those are kind of the things that would actually knock that out. But if you have a relatively healthy individual that's doing fine, they should get through.
And you guys are
younger.
I'm sorry, go ahead.
Oh, I'll say obviously the younger age is going to be a lot more to push, or easy to push through than, let's say, the 45, 50-year-olds that have started to really have some of that health issue.
Gotcha. And you guys are legit issuing that within 3 to 5 days?
Well, the underwriter will take a look at that, and then, yeah, if it's all, we have everything we need, we'll just go ahead and issue that.
Gotcha. So can we get into the sales side of it all? What are some of, like, obviously you guys have some companies that really sell a heck of a lot of product for you guys. What are some of the things that you guys are seeing from some of the bigger producers in your world? How are they really approaching getting these out to the end consumer?
Yeah, so they're really working on supplemental retirement. You know, those are going to be the bigger premium cases. You know, so if you're working with an individual, let's say even a business owner that doesn't really have much for retirement, their whole plan is to actually sell their business for retirement. You know, what's that truly worth? You know, what are they going to buy it off of? And so working with those business owners has definitely increased the premium dollar. And also, again, to supplement that retirement, usually those ages 45 up are even 35 up are pretty good number size cases.
One of the things, Ben, and that I think we have a lot of issues with is people feel really uncomfortable explaining IULs or even getting people to start biting on them. Do you guys have any good marketing materials that are available that will kind of ease the pain of getting that in front of people?
Yeah, absolutely. And I know we had some at that conference, but I'll go ahead and shoot those over to you PDF, and it kind of explains everything from our product to how it actually works. And you can just pass those out as you want.
Yeah, we'll get Rachel to blast them out to our whole entire team because obviously we want everybody to see that. Can you tell me what your guys' average IUL monthly premium is, like, company wide?
Yeah, I would say probably around 2 to 3. We do have a lot of those cases where they're only contributing $100 a month. And that's where you'd be looking at more of that choice product. If you're really actually overfunding that product, you could be putting in $5, $10, $15, $20,000 a year on that.
Well, and
But we do have a lot of those.
Yeah, and I was going to tell
Sorry.
you, Ben, just so you know, your guys' product, like I've had one of your IUL since 2009, and it has absolutely killed it. And so you guys' product is top notch. So we definitely want people to understand that. But so right around $200 is where you guys are kind of seeing your sweet spot, right around there.
No, I would say probably around like $200 a month. Yeah, sure.
Well, and I think and so I don't think people quite understand a lot of times obviously you guys are a supplement sell. You guys are an after the fact type sell for what we go in. I mean, we have a lot of clients that don't put nearly enough into retirements and that need to ease the gap of retirement. And so if people were selling one out of every 5 or 6 people they sit in front of, it, that's an extra, let's just say low side, extra $1,300 to $1,500 in commission for them. And so,
absolutely.
Yeah. What is, are you, and I had a question I wanted to ask you and I was like, oh, it just slipped. Do you guys, have you guys thought about going to just strictly fully simplified issue products at all in the near future? Or are you guys kind of sticking on the route that you're currently in?
No, we're looking at innovating that. Obviously, we have to look at what the industry is doing. We want to make sure that this pass-through rate can get to 80 to 90%. It's expensive for everybody involved to look at APSs and to pull that, get labs and exams done. We're taking a worldwide approach to seeing what we can do to really maximize this and get that number from 33 up to, again, like 80%. So, we'll start and maybe it'll go to 50, but then we're going to continue to be innovative and look at what other companies are doing, look what we can do to be innovative in the marketplace in order to stay relevant.
What, this is a question I actually wanted to ask you. So, obviously we sell some of your competitors' products, right? And so,
Yep.
So we have some guys that are on the call. I'm looking at their names right now that actually are pretty active in the IUL world. I don't want you to put I don't want to necessarily put you on the spot again and pin you up against your competitors, but I definitely want them to know why you would, and not just being because you work with F&G, but why you would choose your product over those competitors' products. Because some of the big arguments are like, obviously living benefits in certain states that come with some of your competitors' products. So how do you combat kind of choosing your product versus a competitor's product? What would you say that is?
Yeah. So, and I'm going to just kind of be straight with you guys too. So I actually worked with a competitor for about 9 years. And when I came over to F&G, there are 2 things that really blew me away. One thing was the transparency of the actual product. So they're not playing any games with any multipliers or anything from an illustration standpoint. What you see is what you get. So we're illustrating this very transparently. The second thing is going to be the indices. The 14.5% cap, again, that's the highest in the industry. I think like the next one that comes close to it is 12. And then at the end of the day, it's that Barclays and that story. I was definitely blown away when I saw what they were able to do with that, and that power of partnering with Barclays in order to get this index on this product. It's a proprietary index. Only F&G can offer that, and it's a big story in order to tell your clients and say, here's this website. Go watch a 6-minute video as to how they're actually able to get these returns. Right now, I think it's the highest index in the industry right now, and we're going to double that return. And so it's just really a powerful story to talk to your clients about that stuff. At F&G, myself coming from an outside carrier, have just been blown away by the interest in what we can do with that Barclays index.
Yeah, your index is absolutely destroying the competitors right now. I mean, not even close. Because I have your competitors.
Yep.
I have your competitors' products as well, and it's not even in competition with they're not even in competition with you guys. So,
Yeah.
and I know you've been really just hitting on the IUL side. Any kind of updates on your annuity side? Like, what can you share anything about the annuities? I know you guys offer them. And I know that's not necessarily your forte, but anything that you can kind of give us some insight on the annuities, why we got you on the phone, if you feel comfortable.
Yeah, absolutely. Yeah, so I have only sat in one, so bear with me here, but one presentation that is. But the fixed IULs that we actually have with F&G, they carry the same weight with the indices. So it's going. You can have a protection-based product, you can have an accumulation-based product that have those riders on there if they were to become sick or injured. But at the end of the day, we're still talking about the same indices that we're using on the life side. They're actually able to use on their side as well. So they do have the Barclays on there, and I think right now it's 140% participation with that Trailblazer product. So it's just a big story to talk about with those indices on our IUL fixed IUL or fixed IUA product.
Annuity. Yeah. Can you just to kind of dumb it down for people like me? Can you talk about, like, give us an example of what do you mean by participation? Like, kind of just give it a dumbed down example of the participation and what that means.
Yeah, absolutely. So what a participation rate is normally you'll see a lot of carriers out there that have 100% participation rate. And what that means is we'll just use the number 10. So the SP 500 index did a 10% return over the year. Okay. If you have a 100% participation rate, you get that full 10%. If you have a 50% participation rate, you get 5%. Now with the Barclays, if you have a 10% participation rate, you get 20%. Because that's a 200% participation rate. So again, 150 would be 15%. So all that means is really what you're getting from that index return. So again, if it's 10, it's 100%, you're getting a 10% return.
That's that. And I think like when you were explaining that, and obviously I know what that means, but what I want people to understand is it sounds very scary sometimes when you're trying to explain participation rates and what goes on with that. It's really not that scary. It's very simple to understand. Yep. You just have to explain it to people in kind of dumbed down terms. I did have a question. Yep. We have a question from someone who says, if someone has, and I'm going to try, I think this is what they mean. And they're talking about IUL. So if someone has $100,000 cash, they want to move it into an IUL. Do you guys have the ability to do a lump sum $100,000, or do they need to move it into like a 7-pay or something to that effect?
We do not have, and so what that means is if they have $100,000 laying in cash, what I would recommend is they could put that into a premium deposit account. Often you'll hear them as PDAs. What they are is that'll essentially just go ahead and say, we are going to split this money up over the next 5, 7, 10 years. That way you do not MEC the policy, because once you MEC that policy, all that tax or all that cash in there could be taxable.
Okay, so he's basically saying, and if I'm not mistaken, you guys have the ability to set it up into that account, correct?
We do not have a PDA,
so
a premium deposit account.
Okay, so you guys do not have that. So basically, they would have to set that up with typically their bank, and set that up into some sort. Set it up, put that $100,000 aside, and what they'll do is they'll communicate with F&G and the bank about how to move that $100,000 into their IUL. Correct.
Yeah, so you can put into a money market. Yep, you can put into a money market, anything that's liquid, and you can move that over the next 5 to 10 years. But again, you do not want to MEC that policy. So you don't want to just dump the $100,000 in.
For all the new people in the IUL world that are on here, can you explain real quick, like in dumbed down terms, what MEC means so they can understand it?
Yep, absolutely. So MEC is a modified endowment contract. What that means is that in order for this to be considered life insurance, you can't put so much money away where it essentially is not classified as life insurance anymore. So how that works is from a taxation standpoint, life insurance is actually sheltered. That cash value inside there is actually sheltered. So as long as that policy is still in force, you can, and it's not a MEC, you can take that money out tax-free. Now, when you dump in a certain dollar amount and it goes beyond what they call we'll just say premium testing. If it goes beyond that, then that's going to be considered a MEC. And when you do MEC it, if you pull out loans or withdrawals, that's actually going to be taxable. So you want to make sure you don't put too much of that money in right away. You want to spread it out over a certain period of years. Does that help?
Yeah, that was very beneficial. Thank you, Ben. Yeah, definitely. Do we have any more questions before we let Ben go? Thanks, Jerrod. Okay, I don't think so. Perfect. Well, thank you so much, Ben, for joining us today. And if we have any questions, can you send me this PowerPoint should anyone need it or request it?
Yeah, absolutely. I can do that. And then I'll also, please feel free to give my contact information out as well. And we'll, if they do have any questions, they can contact me outside of this. Okay?
Yeah, that's perfect, Ben. Thank you so much. I appreciate it. Have a great day.
Of course. Thanks, guys.